Welcome to FinBot Insights. Today, we are tackling the single most important question in the market. Is the current AI boom a rational investment or a ticking time bomb?
It is the question on every investor's mind. Is the immense enthusiasm for artificial intelligence grounded in fundamental reality, or are we simply witnessing a repeat of the speculative mania that ended so poorly in the past?
Consider the staggering velocity of this market shift. The phenomenon began with ChatGPT's sudden explosion onto the public stage and has since escalated into a full-blown investment frenzy. The speed is unprecedented. So, here is our framework for the debate. We will first establish the case for a bubble by examining the echoes of 1999. Then we will rigorously test that thesis against three powerful counterarguments: real-world adoption, the cash moat of big tech, and today's more grounded valuations. Finally, we'll discuss why volatility is the new certainty. Let us begin with the bear case. The argument here is that we are witnessing the same irrational exuberance that defined the dot-com era, displaying all the classic signs of a speculative market bubble. At the heart of the bubble argument is the industry's poster child, OpenAI. Its immense private valuation appears to be built more on the promise of future potential than on any current tangible profit. And this figure is a significant red flag for skeptics: $115 billion. It represents a massive capital expenditure based on demand that has yet to fully materialize, a scenario that feels uncomfortably similar to the dot-com playbook. Now we pivot to the first major counterargument, which asserts that unlike the dot-com era, the AI boom is supported by concrete, real-world application and widespread adoption. The fear of building a glut of data centers is being met with a powerful reality. You see, the demand for computational power is not speculative. It is broad-based, coming from governments, established industries, and consumers who are actively integrating AI technology. And the financial analysis certainly corroborates this reality. Goldman Sachs projects a significant and rapid reallocation of data center capacity, with AI's share of the market doubling to 30%. Taking a huge bite out of conventional and cloud workloads. The second counterargument directly addresses the easy money critique by examining the immense financial strength of the key players that are funding this technological expansion. The capital expenditure is indeed enormous. We're talking over $400 billion. However, the critical question isn't just the size of the investment, but whether the companies making it can truly afford to sustain it. And this is where things get really interesting. Unlike the debt-fueled startups of the dot-com era, today's tech titans are funding growth from massive profits and cash reserves. In their last financial year alone, they generated over $300 billion in net profits and held over $200 billion in cash, creating a financial fortress that insulates them from market shocks. The third and perhaps most powerful counterargument emerges when we directly compare the valuation metrics of the two eras. This table presents the most damning evidence against the bubble thesis. The price-to-earnings multiple, which is the price an investor pays for $1 of a company's earnings, tells a starkly different story. In 1999, investors paid an astronomical $200 for every $1 of Cisco's earnings. Today, the leaders of the AI boom, such as Alphabet and Meta, command multiples in the far more rational range of the 20s to mid-30s. This is simply not the valuation madness of the past. It's not even in the same ballpark. Furthermore, today's market leaders are not one-trick ponies. They are diversified titans with entrenched dominant positions across search, cloud computing, social media, and enterprise software. This structure insulates them from the risk of a single product or market failure, a stability the dot-com darlings never possessed. Having dismantled the primary arguments for a bubble, our analysis concludes that the principal risk for investors is not a catastrophic collapse, but rather a sustained period of high volatility. This expert perspective suggests the AI transition will create clear winners and losers, leading to significant price swings as the market sorts them out. And so, the new focus for investors must be on this dispersion. So, what should an investor expect? Well, you need to prepare for a market defined by these four themes. There will be bouts of volatility as high expectations meet reality, and a growing gap between winners and losers is all that's certain. But underlying it all, major financial institutions see real profits and sustained growth as the primary narrative. And this reframing is the essential takeaway. The conversation must shift from the binary question of bubble or no bubble to the far more critical analysis of which companies will capture durable value in this transformative and undoubtedly turbulent new era. The question is not if fortunes will be made, but who will make them.
If you found this data-driven breakdown helpful for cutting through the market noise, please click like and subscribe. Your support helps us create more content just like it.
And finally, a necessary reminder that our role is to provide analytical frameworks, not to give financial advice. You must perform your own due diligence. Do not trust social media influencers, and that includes this channel, for your investment decisions.